Hello all. Good morning, good afternoon, or good evening, depending on where you're joining us from. And thank you for signing up and attending this webinar, hosted by the Global Legal Insight Series in partnership with the Association of Governance, Risk and Compliance. My name is Ben Lawless, and I'm the head of publishing for the Global Legal Insight Series. First, I'd like to say that we appreciate your attendance as we begin an hour-long session around some of the legal challenges involved when navigating global cryptocurrency regulatory frameworks. It goes without saying there's, of course, a lot to get through from both topical and geographical aspects, and our panel will do their very best and are really excited to provide some high-class insights and thoughts around this topic. We welcome contributions from you in the audience. Our platform's able to take questions through the Q&A function at the bottom of your screen, so please do comment and ask questions today. We'd love to hear from you. And just so you're aware, today's session is being recorded and will be available publicly in the coming week online and to download. Before handing over to the panel, I have 2 points to run through briefly. Firstly, the Global Legal Insights, or GLI, is proud to have launched the 2026 edition of our Blockchain and Cryptocurrency Laws and Regulations Guide just a couple of months ago. The GLI Blockchain and Cryptocurrency publication has insights into 29 different jurisdictions and takes a deep dive into various international trends in the topic via expert analysis chapters as well. We'll be providing everyone in attendance an opportunity to download the 2026 publication on a complimentary basis after the webinar, so do keep your eyes open for that communication. Secondly, I'd like to thank our partner, the Association of Governance, Risk and Compliance. They're a brilliant organisation supporting the GRC community through knowledge exchange, networking and idea incubation. The programs that the AGRC run are raising standards of ethics and integrity in the world of compliance and boosting the industry's knowledge and understanding of best practice, professional development and new technologies. So if you've not seen much about the AGRC, go and have a look at their website after the webinar, agrc.org, and feel free to reach out to myself or Mateo for more information. And that brings me on nicely to welcome Mateo, the Global Manager at the AGRC. Mateo will be our moderator today. He'll do the formal introductions of the panel and move the discussion forwards. So please do enjoy the session, everyone, and good luck to the panel. And Mateo, over to you.
Thank you very much, Ben, for the introduction. Lovely as usual, and it's our pleasure to be here with this esteemed group of panelists, and also co-hosting this event with GLI and GLG, who have become a very strong partner of the association during this past 2 or 3 years that we have been working together. So thank you again for co-hosting this with us. As Ben mentioned, there is a Q&A feature on Zoom. So if you have any questions for the panelists as you're listening to their thoughts on crypto regulations and the frameworks, etc., please feel to drop those into the chat or into the Q&A section, and I'll do my best to incorporate those into the discussion, or we'll save some of the questions for the last 10 minutes or so at the top of the hour, basically. So with that said, let's start with some introductions. I'm going to ask our panelists to briefly introduce themselves, tell us a little bit about who they are, and what is their sort of relationship to cryptos and regulations and whatnot, and the topic of today, I guess. Lisa.
Oh, thank you so much. Thank you for having me today. I'm Dr. Lisa Cameron. So I was an MP in the House of Commons in the UK Parliament for 9 years. During that time, I had the privilege of chairing the Parliament's very first cryptocurrency and digital assets all-party group, which means it was an interest group in the Parliament attended by members of the House of Lords, MPs across all of the parties. And the focus of the group over the 4 years that I was chairing was really education of policymakers about the sector, about the need for regulation, for consumer protection, but also for support to the industry and the good actors doing, what was expected, the clarity there for them to scale and give opportunity to new business ideas and innovations. Since leaving Parliament last year, I've been chairing the UK-US Crypto Alliance, which is an organisation that works between the administrations in the UK and in the US, and is looking to streamline regulatory frameworks across both jurisdictions. And currently we're working on the joint UK-US digital sandbox.
Excellent. Thank you, Lisa. Heather?
Thank you very much, and thank you very much for having me today as well. I can't say that my credentials are as impressive as Lisa's, that's for sure. But I am head of digital assets here at FSCom. We tend to help firms across predominantly the UK and EU, but also globally as well, with their regulatory compliance requirements, whether that be from the authorization stage and helping firms to get registered under the particular crypto asset regimes, through to auditing and advice work as well.
Thank you, Heather. And last but not least, Nathan.
Hi everyone, thanks for having me. I'm Nathan. I started my career as an accountant actually, and I always like to say that I then discovered distributed ledgers, and that's what got me very interested in the technology. So I was working at PwC for some time. I discovered crypto. I got very interested in the technology and the assets. Personally, before professionally, I'd probably have to say or admit. And I wanted to do crypto full time, and that was very difficult for me. At PwC, big organization, moving quite slowly at the time. So I did something which was quite ironic, and I went to work for a regulator. So I went to work for the regulator in Gibraltar, where I'm from. And Gibraltar is quite unique because we were one of the first jurisdictions to have a crypto regime. Before we even saw like worldwide regimes cropping up. So I was part of the team that was licensing and then authorizing companies that were establishing under the regime in Gibraltar, where I'm based, and where I was working at the regulator for 2 years. And then eventually myself and a few colleagues, we left and we started XReg, which is a consulting firm specializing in crypto asset and digital asset regulation. And we work both with the public and the private sector. So we work with a number of different policymakers across different jurisdictions, regulators, helping design and implement regulatory frameworks for crypto. So we've built regimes from the ground up in a few jurisdictions, including in the Caribbean. We're building a regime for a big country in the Middle East as well right now. But we also work with the private sector, doing similar things to what Heather does with her team. So licensing, compliance, that kind of stuff, but very much focused on crypto and digital asset native activities. So working with like global exchanges, custodians, brokers, even some of the more sort of exotic players in the space, like DeFi protocols, NFT platforms, that kind of stuff. So it keeps me very happy as a ex-regulator, but also crypto bro, doing the work that we do.
Excellent. Thank you, Nathan. So we have a pretty sort of broad and I guess we're going to cover a lot of many different jurisdictions. So as you know, we go through we have like 9 questions here that we want to cover. Let's start off with, let's say, to a certain extent, a philosophical question. This was actually suggested by Nathan. So Nathan, you're gonna tackle this first. But why do we regulate crypto in the first place? I mean, why?
Yeah, so there's a short and brutally honest answer, which is we have to. And the reason we have to is because the FATF, which is a global standard setter for AML, they mandate that countries need to regulate certain sectors for AML CFT purposes. Crypto was a bit of a gray area until about 2018 when they said that all jurisdictions need to regulate crypto for AML. What happens with the FATF, if you understand the process, is even though they issue recommendations, so they recommend that countries regulate crypto, it's really more like a recommendation with teeth, because if you don't, you can get grey listed or blacklisted. So I don't think there's any single country that will voluntarily choose to not comply with the FATF recommendations, or maybe a handful, because you have this real risk of being blacklisted. So from 2018 onwards, countries had to start regulating crypto, or they risked getting grey listed or blacklisted. So I guess that's the more like brutally honest answer, we have to. But then I think philosophically, if you think about the way crypto business has evolved, again, pre-2018, crypto wasn't really regulated anywhere. The reason why is because technically a crypto asset didn't really fit in any of the traditional legal buckets. So it didn't meet the definition of a security, didn't meet the definition of money or e-money. So it was this asset class that was just floating in limbo. It wasn't really captured by any legal standards from a regulatory perspective, at least. There's arguments that laws in terms of like insolvency or crime would already capture it, which I think stands in many jurisdictions. But from a regulatory perspective, you could spin up a crypto business by launching a website anonymously. You could take customer money. You could do whatever you wanted with it. There were no KYC AML processes in place, so everything could be done completely anonymously. And as you can imagine, unsurprisingly, that led to issues with financial crime, exchanges, for example, with weak controls being hacked and losing millions or billions worth of crypto. So over time, I think globally, we've acknowledged that we need to bring in regimes to protect consumers, which is what regulation is all about. So I guess the short answer is we have to, and I think the long answer is we need to, because we need to protect people. So I think that's the reason why we've seen crypto regulation develop, and it's also developed significantly beyond AML CFT, which was sort of the baseline that we saw that you had to do. But now we've realized, look, we need to bring in other things in place. We need to make sure customer funds are protected. We need to make sure disclosures are in place, all the things that come with traditional regulation, because the reality is that a lot of businesses working in the crypto space are doing things and conducting activities similarly what you'd see in the traditional space as well. So exchanges, brokers, custodians, similar models, similar risks, but without the regulatory baggage that came with it. Going back years, now we're seeing things change radically.
Thank you. Heather, Lisa, anything to add there in terms
Yeah,
of?
I mean, I would
Yeah.
like to add, well, firstly, I reinforce the part about consumer protection. My first engagement with the industry was in 2021 in the Parliament, when I had a constituent who had lost money on what I now understand to be a rug pull scam. I told him that I would look into who was doing the work in the Parliament on this issue, because he had no way of getting any redress for what happened. And although there were 4 million people in the UK at that point engaged in the crypto sector, we couldn't find any mentions in the Parliament in terms of debates on cryptocurrency at all. So really the population were way ahead of the Parliament at that stage. Now I believe in the UK it's about 9 million consumers who are engaged in the crypto sector. So the consumer protection part is very important. But equally, I think in order for businesses and for the sector to become mainstream, and for them to be able to scale, I think there requires to be clarity of regulation. So it's not just good for consumers, I think it's also good for the sector itself in terms of it having mass adoption of the future.
Thank you. Heather, anything to add there? Or?
Yeah, no, I think it really hit the nail on the head with Nathan and Lisa's comments there. I think there's risks evolve in any financial service, and given that crypto assets is so new to the industry and to the globe, ultimately, we're going to see risks evolving as we get used to how they're going to be implemented. We've seen the rise and fall of NFTs. We've seen the rise and fall of certain different ways of actually utilizing and stable coins, obviously a big element at the moment. So I think as we get to see the adoption of this new technology, of this new asset class, we're going to see the risks evolve. And that obviously started with very much, we think this is quite a big issue around money laundering. But then to Lisa's point, it's then evolving into, money laundering is one thing, but we also need to be protecting consumers, protecting the individuals utilizing these assets as well, and being adaptive and being able to ensure that we're putting the right regulation in place at the right time is going to be vitally important.
Excellent, thank you. So with that said, let's take a deeper dive into actually what's happening across major jurisdictions when it comes to the regulatory philosophies. So how do the regulatory philosophies differ between major jurisdictions, UK, Asia, etc.? And what are the implications of these different approaches for multinational financial institutions seeking or looking to offer crypto services? Heather, do you want to give us a general approach, and then we'll jump into some of the more specific regional divergences?
Yeah, absolutely happy to. So I think One of the things I find really interesting about crypto assets in particular is the decentralized nature. You know, every other financial service that we offer as a global, jurisdiction by jurisdiction has assets by assets, fiat by fiat. Every currency is unique to the jurisdiction that it's accessible in. That isn't the same for crypto assets. It is completely a global product. So although we have global entities, we have global banks, we have global payment institutions, etc., it's very much that you have to get regulated and understand your regulatory regimes in each jurisdiction that you go to. And it is going to be different because there's going to be different products there. However, with crypto assets, we have this one product that is then being implemented in multiple jurisdictions. So it's a top-down approach rather than a bottom-up. And I think what we find with that in that case is that it means that firms want to have centralized operational capabilities and streamlining those. And when it comes to the money laundering regulations, we do quite a few of these sort of global AML audits where we go in and we see how firms are being able to implement this. And it's fascinating. To Nathan's point earlier, you know, we've got FATF's recommendations that are very clear on the standards that should be being applied across the globe by different regulators, different jurisdictions. Yet they diverse so drastically in some areas. I mean, one of the things that we really see firms struggle with, for example, from an MLR's point of view, is suspicious activity reporting and the differences between the different ways in which jurisdictions expect you to be able to implement those controls. So there really is, although we've got a very global product, we still have these firms having to apply very jurisdictional requirements. And with the MLRs, as I say, there is FATF, which is looking at the whole globe as a centralized place to set a reasonably harmonized approach. However, financial services does not have the same applicability whatsoever. You know, if you take payments firms, investment firms across the whole jurisdiction by jurisdiction, their regulatory regimes are very different, and how they're implemented is very dependent on the risks associated with that jurisdiction. So I think what we're going to start seeing is, as the likes of MiCA, as the likes of the FCA's approach to regulating these entities under financial services regimes, we're going to start to find that this harmonization is breaking down even more. There is some good news, as the FCA have created sort of a transatlantic task force and sort of speaking with the US, trying to make this as harmonized as possible. But I think there's this idea that we can't duplicate globally. It's about how we can make this harmonious regulatory environment to allow this global product to exist.
Right, excellent. And within this context, Lisa, do you want to talk a little bit about the work being done between the US and the UK in terms of harmonization?
Yeah, I mean, sure. I think it's a very exciting moment in that sense for the UK, when we had the parliamentarians over in the US just in October, meeting with the Crypto Task Force, with Paul Atkins and with Commissioner Pearce. You know, there was a kind of excitement that there could be this UK-US digital sandbox where companies can perhaps passport between the UK and the US. And of course, this will then widen to, you know, other jurisdictions simultaneously or subsequently. So this is being worked on by both Treasury. There's a number of key meetings being held, you know, from this point in time right through to the first quarter of next year. And then there should be recommendations at the end. So I think, although there's a kind of, it's become a race in a sense globally in the industry, I think it's helpful to also have this idea and concept of interoperability and trying to have this harmonization and some shared standards as well, because, you know, that's obviously much better for clarity for the companies involved because it's global, but it's also, you know, a bit easier for consumers as well, and I think as well for trade, you know, internationally. The other interesting thing is we've had MPs out and members of the Lords out to speak in Dubai, which has become a bit of a hub, and have discussions with VARA about their balancing that they do between innovation, harnessing that, and consumer protection. And they have a kind of balancing scale that they use. And I think there was a feeling that perhaps in the UK we're kind of veering a bit too much towards sort of bureaucratic compliance angle and not so much considering the innovatory part just now. So there's hope that can shift a bit. And I think obviously with the US having the Genius and Clarity Acts, with a focus on stable coins, things have really shifted up a gear internationally. And whereas the conversation between policymakers last year, before the new administration in the US, was about whether we should have crypto at all or do anything, at all, really. Although, as I said before, the public were way ahead already in terms of their engagement. This year, that conversation has shifted to how to do things, how to engage and how to collaborate. So I think there's now an acceptance that the sector's here to stay, and it's about how to take things forward in, a very sort of helpful way for consumers and for industry.
Thank you, Lisa. And Nathan, your experience from some of these other jurisdictions in the Caribbean, Middle East that you work with, I mean, what's your position there?
Maybe just like a quick observation on harmonization. I don't want to sound like too negative. I really struggle. I really struggle with harmonization in the sense of like harmonization to the level that we can passport services across jurisdictions. I think is extremely difficult to achieve. We haven't done it with the traditional financial sector. I know crypto is different, it's a bit more cross-border. I really struggle with whether we'll achieve that globally. If we can achieve even like part of that with the work that Lisa's doing between the US and the UK, that would be amazing. What we do, I feel, is we do have a big degree of harmonization globally at like a high level principle perspective when it comes to crypto, right? So almost every jurisdiction is regulating crypto. Almost every jurisdiction is working on a regime for issuance of assets. So the way I like to look at crypto regulation is in like two key buckets, right? So you've got issuance of assets, which you could then split between like issuance for fundraising purposes, like ICOs, which are more disclosure based, and then issuance of stabilized assets, like stable coins, which requires a bit more because you're basically maintaining a pool of reserve assets that customers can then redeem against, and you're trying to keep like the value of a token relatively close to like the reference asset that you are issuing. Then we've got the second big chunk of crypto regulation, which is on businesses. So service providers, exchanges, brokers, custodians. Again, the regulation is largely similar in most jurisdictions, right? So you have to have like conduct of business standards, AML, prudential to certain degrees, depending on the jurisdiction. So from a harmonization perspective, at like a high level, I think we're actually doing quite well. Where I think the challenges really come is when the devil's in the detail. And you're looking at like the detailed rules, like for example, the UK and the EU going for quite a rules prescriptive based system, some other regulators going a bit more principles based, some being very strict on certain things like reserve requirements for stable coins, needing a certain percentage being held in local banks, others don't. Some jurisdictions are like banning interest bearing stable coins, others are allowing it. That's why I think you get these sort of little issues when it comes to potential passporting across jurisdictions. So I'd love to see it, and I think if Lisa achieves it, I'll be very, very, very happy.
I don't think the onus is just on me.
So no pressure, Lisa. No pressure, Lisa.
No pressure, Lisa. No pressure.
I am a bit skeptical, but generally across the world, like most jurisdictions have actually quite similar regimes. Some are a bit more detailed than others. The devil's always in the detail. You've got jurisdictional quirks pretty much everywhere. Most jurisdictions either have developed bespoke regimes for crypto. Some have just tweaked their existing legislation to accommodate crypto. So like Singapore amended their Payments Act, for example, to regulate cryptos as payment instruments. The US apparently has always regulated crypto because they're all money transmitters. So since the money transmitter legislation existed, supposedly that would have captured crypto already. And now you've got obviously other initiatives in the US, but I think that's the challenge I have in my mind when it comes to passporting, cross-border services. So what you do start seeing is the way these large multinational companies like banks have worked, which is you just have this patchwork of entities, regulations you need to comply with, and you end up having this web of regulated companies if you want to actually service the entire world.
Yeah, and I think that's fair, and that that's what we're likely to have in the first instance. I think this is though going to become very competitive, and I think the first level of regulations we'll see will be amended and adapted over time because different jurisdictions will have to up their game or they'll risk falling behind. And I think I'm hoping and that's where much of the work we're doing, apart from the joint sandbox initiatives, which are very exciting, that you're going to see some level of standards becoming equalized, I suppose, because otherwise some jurisdictions will just lose the business, and you're going to have some falling behind others. And I think once the penny drops that this is going to form a large part of the future of the economics of most countries, then that's when things have to really be taken to the next level.
Mhm. Now, let's look very quickly at stablecoins. I know we mentioned stablecoins here and there. I think Heather mentioned, Nathan mentioned them too. But with stablecoins representing a critical bridge between traditional finance and crypto markets, I mean, how are different regulators approaching their oversight, and what lessons can be drawn from recent regulatory responses to stablecoin depegging events and bank failures affecting the sector? Heather?
Yeah, absolutely. I think from a stablecoins are going to change. In my personal opinion, it's the element that I'm probably most excited about. With a background in payment services and e-money, I think stablecoin is, for me, the future of how we move money. As it exists at the moment on a cross-border payment basis, it's clunky, it's expensive, it takes multiple institutions to be able to be involved in that process to make your money move from A to B. And with the capabilities of stablecoins, that complexity will be eradicated. So I think for me, what's really interesting though is how firms are able to then utilize those stable coins, whether it's you as the customer knowing that you're involved in an actual crypto asset exchange where you are exchanging your fiat for a stable coin in order to move that cross-border, or whether firms are using that more as a liquidity provision in the background to be able to initiate cross-border payments for their own purposes. I think the future of payments and how we move money is going to be fascinating with stable coins. So I think for me, that's more around how we then regulate it from is it a true exchange, right? How do we actually consider the exchange between a fiat currency to a stable coin, and whether that should be seen on the same par as the exchange of fiat for a crypto asset, right? An actual exchange token. Should they be considered in the same breadth? Should they have had the same regulatory regimes? Should these payment services firms be regulated under crypto asset exchange regimes when actually all they're doing is fiat to stablecoin? So I think there's a really interesting argument there around it, what actually is stablecoin being used for, where the actual risks are for the customers and risks are for the institutions providing these services, and how to then best regulate them. I think there's still in my opinion, a lot of questions around how that's going to be implemented effectively on a global scale.
Thank you. Nathan?
Yeah, I agree. And I also think that stablecoins are going to be one of the fundamental use cases of crypto, at least in the next few years. I think if you look at the development of like tokenization and tokenized assets, you need a stable currency-like asset that you can then use to trade between tokenized assets. So without effective use of stablecoins, I don't think we're going to have effective tokenization or tokenized assets. I think when it comes to depegging of stablecoins, what people seem to, or what can be confusing is if you consider a stablecoin to be e-money or money. Even though it's very similar to e-money or money, it's not. When you are purchasing a stablecoin, really what you are purchasing is like a ticket or a receipt that you can then redeem against the issuer. The price of that stablecoin can actually fluctuate, hopefully not significantly, but it can fluctuate. And I think it's kind of a feature of not a bug when it comes to stablecoins, right? Because if the price is lower than the par value, you can buy off market and redeem against the issuer. If the price is higher, you'll just sell on market, and that's how the price stabilizes as close to $1, for example, as possible. Where these depegging events occur largely is a result of market losing trust in that stablecoin. So there's a loss of trust. People start selling. It goes below the par value or the peg value, And if the market is not willing to buy that and redeem against the issuer because they believe the issuer either has two issues, one, liquidity issues, or two, it doesn't have the backing of the reserves, that's when you lose the peg. But if we have sensible stablecoin regulation on issuers, which is what we're looking at now globally, where these issuers need to maintain a solid reserve that backs the assets one-to-one, where there's liquidity requirements in place, so they can redeem against anyone willing to redeem against the issuer, then that depegging should only be a temporary issue as opposed to like a failure in the stablecoin itself. So that's why I think regulation is very important as well. So we really need to trust the issuers of these assets to make sure that they're actually holding the reserve they say they're holding, that there's no issues with the technology. But as well, liquidity is a big thing, because you have like a run against the issuer, even though their reserves may be sufficient, they may not have enough liquid reserves to pay out. And that's where you've seen a lot of development in stablecoin regulation, focusing not only on backing of the assets, but also on having sufficient liquidity to meet redemptions.
Excellent. We have a question here that's actually, since we've been discussing tokenization, and what, if anything, is happening with the tokenization of non-securities real-world assets? For example, monetized income streams. The person asking says, I cannot find anyone engaging with this topic. Anyone care to give him an update?
I can maybe give a little update in the way I feel we need to approach these sort of tokenizations. There's like, I see tokenization in two sort of paths, right? There's direct tokenization, where the token is the asset. So an equity that is tokenized, you can either buy an equity which is the token, which you don't really see anywhere, or you can buy like almost like a stable coin version of an equity, where somebody will be holding a pool of like Apple shares, for example. Then they'll give you a token and they'll say this is tokenized Apple, but really the asset you're holding isn't a tokenized Apple share. You're holding, again, a receipt against an issuer who will give you economic exposure to the Apple share. So to answer the question, I guess we are not really seeing a lot of direct tokenization. We're not seeing, for example, like properties and land registries being directly tokenized. What we're seeing is this sort of indirect tokenization, where an entity or an SPV will hold an asset, tokenize it, issue this sort of receipt. We're seeing a lot more of that right now. The reason why, because it's easier to achieve. You don't have to change a lot of like the very traditional legislation to do that. So that's probably why you're not seeing a lot of this sort of like direct tokenization of assets. Right now, there's a lot of roundabout ways of achieving the economics behind the assets, but not actually receiving like the direct tokenized interest in the assets.
Yeah, and I think like there's a huge amount of interest in this just now, particularly when it comes to property. We've had a number of sessions with parliamentarians where we've been learning about tokenization of property, whether or not it can kind of democratize investment in property as well, so that perhaps, maybe an individual can't afford to purchase a whole property as an investor, but they can, it'll be fractionalized and they'll be able to, have that as part of their portfolio, perhaps. There are also some companies I know, Code Lab are tokenizing one property, one token just now. And it was very interesting, but also funny when, we were speaking to parliamentarians about the tokenization of the apartment they have on the Thames of London. Very interested in seeing this apartment. What did it look like once it'd been tokenized? Did it affect the foundations? So we even had to kind of like, talk about what tokenization meant.
Excellent. Let's shift gears now a little bit. Let's talk about AML and CFT compliance and the travel rule. And how are financial institutions implementing the FATF travel rule for cryptocurrency transactions across borders? This is something that I think Nathan can help us out with. And then, what sort of technological and operational challenges arise when counterparties operate in jurisdictions with different implementation timelines or standards? And Heather can kind of cover and jump in there. Nathan, the travel rule?
Yeah, so I could talk about the travel for hours probably, but just to keep it short. So
you have like 3 or 4 minutes.
I guess just to really, really quickly touch what is the travel rule. The travel rule basically is a requirement to exchange information when there's a value transfer between one VASP and another VASP. A VASP is like a virtual asset service provider, which can be called different things in different jurisdictions, but basically a regulated crypto company, if it's sending value from themselves to another regulated crypto company on behalf of a customer, they need to exchange certain information. So if I have an account with let's say a UK licensed crypto exchange, and I want to send some Bitcoin to Heather, on Heather's account in an exchange in Singapore, my exchange and the Singaporean exchange will have to speak to each other somehow and share our information. So one will say, Nathan is sending Bitcoin to Heather. The other will say, thank you. This is Heather's information. The challenge with that is this already exists in a traditional financial system with SWIFT, for example, between banks, but that never existed for crypto until the FATF again. Our friends at the FATF decided to change their standards and say, actually, this needs to happen for VASPs and crypto companies as well. So effectively, from one day to another, we said like the industry needs to have like a SWIFT, but for crypto. What we see now, which is extremely challenging, is that jurisdictions have moved at different paces in terms of actually implementing the rules, the technology and the solution in terms of the exchange of information between different crypto companies just simply didn't exist. And all of a sudden, we had a number of competing groups that were looking to develop a solution to fit this problem. So we have a number of different technical solutions that different crypto companies are using. They don't all talk to each other in the same way. They use different standards. So that's really why the travel has been such a huge compliance headache. So to answer your question, I think it's still a challenge. A lot of clients of ours even are using multiple solutions because their counterparts may not use the same one. So you may have companies that are using like 2 or 3 different solutions just to be able to get as much coverage as possible. So it is a challenge. One of the reasons we got so involved in the travel rule actually is that we helped develop a data standard in the very beginning. It's called IVMS 101. And this is a standard in terms of like the payload that needs to be shared under travel rule. So something simple like do we put first name or last name first? Do we use like US or British dates? How do we format this information? There was a big effort in the beginning that we were involved in. There were like 100 experts that gathered together to develop this standard, which is being implemented by pretty much everyone in the industry, which I think was a big achievement. So the actual information that is exchanged on the payload of that information is quite standardized, which I think is a very positive thing. But how that information actually gets delivered is also very tricky. And again, it doesn't help that different jurisdictions are at different levels of implementation. Some jurisdictions don't even enforce the travel rule effectively. So if you're an exchange in a compliant jurisdiction, you may not even be able to actually effectively execute a travel rule transaction if you're dealing with an exchange in a non-compliant jurisdiction, for example. And that's known as the Sunrise issue, and that's been a big problem as well. I do think that over the years, as the industry gets more regulated, as we start harmonizing all the standards, I think this will be easier to comply with, but we're still in this sort of in-between phase, I think, where we're still working on it. Not every jurisdiction is aligned. I think fast forward maybe 5-10 years time, it won't be as big an issue for everyone.
Heather?
Yeah, I think it's interesting from an AML point of view. I think it goes back down to what I said at the beginning of the webinar, really is about this. It's not only the lack of harmonization, I suppose. It comes down to the fact that jurisdictions just take different approaches and as to how they implement the FATF standards. So it could be that you've got one jurisdiction that's got quite prescriptive rules that are quite rules-based that you have to follow, or somewhere more like the UK, for example, which is very risk-based and very sort of down to your own risk appetite and proportionality. You then have sort of your national risk assessments, for example, where maybe you have each jurisdiction has its idea on what the risks are. That is then implemented into the firm individually in each jurisdiction and digested into their risk appetite and their approach to risk. And then you've got the MLROs dedicated to each one of those jurisdictions. You need to have the autonomy to be able to be decision makers and to feel comfortable with the risks that they are allowing the firm to consider as part of that approach as well. And then that all needs to feed back up into one global entity. So I think that's where we probably see the biggest struggle for firms that are in the crypto industry, is very much this. there needs to be an approach where the jurisdiction by jurisdiction you are analysing and implementing controls effective to the risks that are associated, but at the same time trying to have everyone onboarded in the same way, that your transaction monitoring has all the same rule alerts, that you can identify what your suspicious activity is and report it all by the same manner. It's a really difficult balance to get right, and we definitely see that firms are still struggling to get there, I think, to have those elements that need to be different and should frankly be different versus those that they can try and harmonize at a centralized place.
Thank you. Moving on, we have about 20 minutes. I have a few questions that have come in from the audience, so I'm going to kind of save those towards the end. But now let's look very quickly at DeFi and smart contract regulation. And, how should regulators approach DeFi protocols that operate without traditional intermediaries? And where does legal liability rest when smart contracts execute autonomously? And how can traditional regulatory frameworks adapt to this paradigm? Nathan, you want to cover that very quickly for us?
Yeah, happy to. I've been doing quite a bit of work on this with policymakers, with clients as well. It's probably the most challenging area because it doesn't really fit in any of the traditional buckets of regulation. But it's probably also the area where like real innovation is happening, I think, in crypto. If you think about the way the whole reason why crypto was created, right, was to decentralize payments and financial services. And this is where the technology really challenges traditional ways of thinking. So, for example, regulators have always identified like a single point of failure or control, an entity that they can call if things go wrong, that will be made responsible for everything. When you're looking at DeFi, what you're doing really is you're sort of breaking up the provision of a financial service, for example, into like different slices. And each of those slices could be operating independently by different people. So how do you regulate something that doesn't have a central point of control? Even governance is dispersed everywhere. The way I see it is you should separate the infrastructure and the access point. So I like to think of like let's say a layer one blockchain or a smart contract as infrastructure that people build on. The first thing you need to consider is, one, is that infrastructure decentralized or not in the first place? There's a lot of self-proclaimed decentralization where you actually do have people that can be responsible and maybe are actually responsible for certain bits of code, or there's like admin functions. So, but provided that it is actually decentralized, how do you address it? I think the only thing you can do is make sure that that platform is robust. And that's where you get things like smart contract audits that are very important, like making sure that the whatever you're building on is as secure as possible. So code quality standards, audit frameworks, a lot of this is actually happening already. So a lot of like, for example, smart contracts, platforms, DeFi protocols, they will have their code robustly audited and challenged. I think that needs to be an industry standard. So I think we need to work on like global audit standards for smart contracts and decentralized applications to make sure that they're robust and that whatever you're building is you're actually building on decentralized infrastructure. And then the next thing is the access point. So, and this is where like you are seeing a bit of regulatory development. So, and this is mainly going after like front-end interfaces to smart contracts and to dApps and DeFi applications. That's where you can actually maybe have some accountability from people that are actually hosting these front ends. That's where you can implement maybe AML controls. I would like to see a world where these frameworks are more like disclosure based to start off with, focus on consumer protection. So if somebody wants to access a DeFi protocol for a front end, the front end should be responsible for making sure first that that infrastructure is robust, make sure there's been an audit, highlight a number of different risks to the customer. Like I'm allowing you to access this protocol, but there are certain risks. These are the risks. And as well, I'd like to see some sort of AML framework on front ends, but maybe not to the extent that we gates the whole system and turn it into CeFi again. Maybe more focused on like blockchain analytics, that kind of stuff. So just to make sure that people aren't, or you're not allowing access to like sanctions addresses of individuals, but you're doing more on a risk-based approach as opposed to like making a front end interface a financial service operator. That's the way I like to see it. I don't know if that's exactly what will happen. I think there are people working on frameworks like this. The easier thing, which I think is the wrong thing to do, is say, let's make anyone that deals with DeFi a financial service provider. Let's make them the same as other regulated crypto companies or banks or investment companies, because I don't think that addresses the risk. And to Lisa's point on innovation, that would definitely kill a lot of innovation happening in this space, I would say.
Yeah.
Lisa, from your experience, yeah.
I think that's why we need people like Nathan coming into parliaments to explain to the policymakers, because most of that is really like way above the technicality that policymakers understand. So it's difficult to understand the risks when you don't really understand the fundamentals of how things are working. And that's why we're doing sort of one-on-one type education programs, being very simple about it as well. I mean, we've had people come into the parliament talking about CeFi and DeFi and Bitcoin and blockchain. And, people, the lords are sitting there, and the MPs are sitting there not understanding. And I always remember one event we had where all of these terms were being used, and then someone spoke about fiat. And one of the members of the House of Lords said, "Fiat, that's a car." I understand what you're talking about. So we need to be kind of like communicating on a level that's not, so jargonistic as well. And people like Nathan who can, transcribe that into everyday understandable issues for policymakers, very, very vital. Or else people just tune out and think, this isn't for me, I'm not going to speak on it in the Parliament. And actually, in June, when we went to the European Parliament and spoke with members of the European Parliament, many said they would like to have more understanding, information, and education. And they didn't have this, and that's why they avoided speaking about these issues in the Parliament. So we need to have much more of this education on the issues that are very, very relevant for the industry in terms of moving things forward, and also for the consumer protection we've spoken about.
So just, one point then, I guess, so 100%. And a lot of what we do actually is trying to explain things in as least technical a way as possible. And I'm sorry, maybe I lost a few people with the DeFi, CeFi jargon, but one of the funny things, though, the way I like to explain DeFi to a lot of people, it's almost like a vending machine. So you go to a vending machine, like you want to buy a drink, you put your money in, you expect it to work, you take it out. That's almost what DeFi is. You've got this machine that you trust, that you rely on, the standards in terms of how they're built. Gets a bit more complicated because in DeFi you'd be maybe incentivizing anyone to like put cans in the machine, which is a bit different to how normal vending machines work, but that's really what DeFi is. But I agree 100%. Like we do need to try and like explain things.
No, it wasn't you, Nathan. I'm not mentioning who it was, but we've had people come to the Parliament and try to explain blockchain and talk about layers 1 and 2 and nodes and all sorts of things. And it sounds like something from Star Trek. So the MPs just tune out.
So along those lines, we have a question here from one of the audience members, and it's like, what is the difference between VASP and CASP? So in 1 minute, for someone who doesn't know.
Do you want me to take it?
Yeah.
So short answer, not much at all. A lot of jurisdictions choose different language to explain the same thing. So VASP is like the FATF terminology. CASP is the European terminology, crypto asset service provider. Long answer again, though, the devil's in the details. So the way people define these operators in different jurisdictions can be slightly different. Really, they're like crypto service providers, so exchanges, brokers, custodians, those kinds of people. But then when you look at the technical way they're defined, FATF will define activities like exchange, transfer, custody. The Europeans like to copy paste MiFID. So they've defined different activities like exchange, reception and transmission of orders, all these weird and wonderful things. So I'd say it's like a 95% overlap. But again, the devil is always in the details. So like the Europeans have like investment management type activities in relation to crypto are in their regime. That may not be the case in a FATF regime if you're not like touching the assets, for example. So there could be cases where a business is unregulated in one jurisdiction, but we're regulated in the same jurisdiction. You get these like nuances, but it's like 95% the same. So if you hear like VASP, CASP, DPT in Singapore, for some reason, the only country that calls them digital payment tokens, it's largely the same thing, but it's not.
There you go. making things simple for the audience members. We have another question here. This has to do with inclusivity. I'm going to combine two of them. But there's a comment here from a gentleman who says, I don't see anyone from the industry speaking about inclusivity, basically ensuring that it reaches the common man and society benefits from crypto products. And then the question is the government or the regulators focusing on inclusivity rather than just making crypto products available for corporations or corporates? Who wants to tackle that? Lisa?
Yeah, I mean, I think that that's really relevant. It's very pertinent to the whole discussion. And, we've had so many presentations in different parliaments now to policymaker groups. And most of it has been about, what is this? What is that? How does it work in the corporate world? And only recently did I go to a conference, Blockchain for Good, in Copenhagen, where they were talking about how developments in the sector can actually reach out globally, help us achieve the Sustainable Development Goals, and make sure that the communities who have been traditionally left behind by financial services are not equally left behind by new developing financial services. And I think that's really important conversation. And I know when I speak to members of parliament, that's the question that comes up. Yes, this is happening, but how does it benefit everyday people? What's the use cases? What are going to be the benefits? And some of the interesting ones we've looked at so far are, I suppose what was mentioned before, the use of stable coins to get people's money from one jurisdiction to another with lesser costs. But also we had some input from some of the team from Argentinian Parliament who described the levels of inflation in the country, meaning that consumers were then relying on perhaps more so stable coins because they felt that their money was devaluing. So in certain jurisdictions, you can see really clear use cases where the public have actually utilised different types of digital money, I suppose. And then, we also had input from the Deputy Digital Minister from Ukraine, who spoke about how when traditional finance kind of collapsed in the first few days of the conflict, that they were able to get funding in cryptocurrency to those in the front line. So, and international aid is another example. And we heard about that at the conference in Copenhagen as to how the United Nations are looking at aid payments to the most vulnerable on blockchain, using blockchain technology, making sure that it gets in a transparent way to the most vulnerable person. So I think these are developing use cases, but they're definitely the ones policymakers want to hear about in order to see the value of the sector as a whole.
Excellent. Heather, want to jump in?
Yeah, I think there's a really interesting conversation here about inclusivity versus accessibility, because actually I think what a lot of jurisdictions are more concerned about is not an issue of inclusivity. Is actually that these things are very easily accessible. So where traditional assets and access to securities, etc., is very much behind a wall for a lot of individuals and a lot of consumers in the space. You have to either be a certain level of understanding to be able to access those products, or you need to be utilizing third parties to be able to access those products. The actual crypto assets as they stand today are highly accessible, hence why I think the numbers are something like 23% of young people own some form of cryptocurrency. I know it's the first thing I bought as an asset before I bought anything else other than pensions, but we won't go there. So I think from a actual inclusivity point of view, it's inherently inclusive. Actually, what it's about doing is ensuring that we're then protecting the people that are getting access to those assets.
That makes sense. Along those lines, I have a question here. Now we're going to start, let's say, looking towards the future, and I want to get a forecast from the three of you as to where we're headed. But there's a question here that can kind of get us started on that discussion. But from your experience, what do you see as the most promising directions for future reform to strengthen the legal protection of cryptocurrency service users in different jurisdictions, whether it's under civil law, financial regulation, or consumer law? Lisa, do you want to get us started with that one?
Maybe I'll not start. I'll try and add a policy perspective after we've had the technical perspective, if that's okay.
Heather, Nathan?
You have to forgive me because I can't remember the name of the act specifically, but I know there was a change, is it this week or last week, around the Property Act to include crypto assets in there. So I definitely think this idea of crypto assets being something that you own and being descriptive and being protected as an asset for an individual is certainly progressing. I think it's one of the first jurisdictions to really consider this and actually include it in policy and have it down in a statutory act. So I definitely think there is progress in this space and understanding what your legal responsibilities and legal ownership responsibilities are revolving crypto assets is definitely evolving, and at least from a UK perspective, it's something that we're seeing is actually being taken quite seriously and progressing from that regard.
Nathan, anything to that? Go ahead.
Very quickly, so yeah, I agree 100% with what Heather said. I think just having the foundations there is very important. So like crypto assets being considered like or the theft of crypto assets being considered a criminal offense, and having those protections available, I think, is extremely important. The challenge, I think, is that law enforcement are probably not very well equipped to like follow through once some of these risks crystallize. So I think maybe implementation rather than changing laws is what we need to focus on next.
Yeah. And I agree with that. And I think it was a great development this week in the UK to see that come into statute. But I think, like, more broadly, it was very interesting when we had the Children's Parliament come to speak to us in the UK. And they represent all of the jurisdictions, the constituencies in the UK, and they come to tell MPs what's important to them. And they're aged from around about 7 to 15. And when we had them all in the room with the Lords and the MPs, and we were talking about, digital money, and everything in their life is kind of digital. They're very digitally native people. They're very sort of ahead almost of the Parliament. So even when people were talking about Web3 and there was a question, who has heard of Web3? All the kids had their hand up in there, hardly any MPs and no members of the House of Lords at that point in time. So I think that this is it's part of a digital sort of revolution in a sense. And I think we need to get the education right as well, because I think jobs of the future are not going to be the same as jobs of the past. And I'd like to see financial education, including how finance is changing, and that we, impart more knowledge to generations to make sure we can utilize their skills for the way ahead. Because they said to us, everything's digital in our lives. Of course, finance is going to be, but you just have to make it safe. And I think that's the job of the legislators. Right. Yeah.
Now, very quickly to wrap up, and we have a few minutes left here. What is your one forecast? Let's say your five-year plan or forecast into the next 5 years for crypto regulations, or what's your one hope? Where do you see things headed, Heather?
I'm really hopeful and really excited for the UK regime. I think it feels a little slow, but it has to be. I think there has to be this level of consultation. There has to be this level of discussion papers. We need the input from the people who really know, the Nathans in the room, that can come to the table and really have their 2p to add to how this regime should work. And I do have hope. I do have hope that the UK could become a hub. I know I might be a little bit out on my own in that hope that it might be the UK as the leader in UK regulation and in global regulations, but that's what I would like to see. 5 years' time, everyone's banging at the door at the FCA to be let in to be able to trade crypto from here.
Excellent. Nathan?
So maybe it's a tricky one. I think short term, what we'll see jurisdictions finalize their regimes. So we'll have like concrete stablecoin regulation everywhere, regulation for service providers. I also would really love to see the UK take more of a lead. As to Heather's point, I think they have a big opportunity. I think being a second mover advantage can be actually quite strong. So the Europeans massively overcomplicated their regime. The US, even though they've changed their stance, is still moving relatively slowly, I'd say, even though there's a lot of work on their bills, but we still don't know exactly what's going to happen there. So I think the UK do have a good opportunity, but what I'd like to see longer term is maybe the point I mentioned before in terms of like natively issued tokenized assets. So I would like to see more jurisdictions coming up with like innovative approaches to like tokenizing like share registers, tokenizing properties, but not where you have to hold them through an SPV and give someone a receipt and then have reliance on this entity to not fail to be able to redeem your money. That's what I'd like to see eventually. Plus DeFi regulation, which again I'm very passionate about as well.
Excellent. Last but not least, Lisa.
Yeah, I'd like to see more discussion and debates in all of the parliaments, the MPs feeling more informed and able to engage in the policy making or in this sector. So we're continuing our programme of education. People have been banging on the door of the FCA to get crypto regulation for years. It needs to be streamlined as a process. Thousands of people are leaving the UK to go to other jurisdictions because of the lack of engagement, but also the way the system's operating just now and the taxation, etc. So I'd like to see some incentives for entrepreneurs, innovators to be in the UK, to stay in the UK, and to scale up in the UK.
Excellent. With that, I think we've reached the end of the webinar. I know Ben is going to pop on and say goodbye to us. But thank you so much, Lisa, Heather, and Nathan, for this great discussion. I think we covered a lot of material. There are a few questions I had to leave out because we have plenty of questions from the audience. But I think it was a great sort of, let's say, preliminary discussion on the crypto frameworks. We can do this. We can do this again in what is it, in July, June, when GOG organizes their conference. We could do this and then actually go out for a beer or something along those lines. So thank you.
Amazing. Not a tokenized one, a real one.
I hope so.
Sounds good, Mateo. Thank you all for a fantastic hour discussing the blockchain regulatory legal landscape. I hope everyone who's tuned in today has found the session as interesting, dynamic, and useful as I have. Heather, fantastic points on stablecoin being the future of moving money cross-border and how it could and should eradicate complexities. Nathan, really interesting ideas on issues around decentralization and the need for robust frameworks to combat that. Lisa, I really liked you highlighting the need for education on the subject, particularly to those in power of making big decisions in parliaments and House of Lords, for example. And I think the big news is Nathan has put global harmonization firmly into Lisa's hands. So we're all wishing you best of luck with that, Lisa, as well. So thanks, everyone. All that's left for me to say is please do keep your eyes open for more from the GLI team around our blockchain and cryptocurrency resources, particularly our hugely popular blockchain and cryptocurrency symposium that Mateo has just alluded to. That will be taking place again in London around June, July next year. Do also take a look at the AGRC and how they can help you. And of course, if you have any follow-up questions, please do reach out to us. Thanks again, Lisa, Heather, Nathan, and Mateo. All the best, everyone, and we'll see you next time.
Thank you.
Bye, everyone.